so much for tuning in to this conversation with Dr. Satyanarayana Chava of Laurus Labs. They came out with the quarterly numbers yesterday, below street estimates. Fluid situation. Let's try and understand from him how he thought or what he thought were the pressure points, and how do these pressure points transform or ease themselves into the rest of the year, and some of the building blocks that they've put into place, because clearly they've also signed a multi-year commercial contract with a leading global crop science company, which is the first of its kind that I believe Laurus has done as well. Dr. Chava, good having you. Thanks for taking the time out.
Good morning, Neeraj.
Good morning. Dr. Chava, I have to ask this to you. When we spoke the last time, you had spoken about FY24 being a year of consolidation. The start to the year of consolidation has been anything but that. So how do you read what happened in the quarter? And are there any takeaways for the rest of the year from there?
The takeaways from the quarter, the first one we need to consider is ARV prices have stabilized. ARV API volumes were almost constant. In fact, we are running our ARV APIs at full capacity. And ARV formulations are also picking up. We have a very good order book from Q2 onwards. So ARV stabilization happened. That's the one key. Prices are stable right now. In the non-ARV space, we have seen a lot of interest in oncology APIs. If you look at our oncology API sale, you can't see quarter on quarter. You have to see here. We were doing about 300 crores oncology APIs per year. Although we did 60 crores, around 59 crores last quarter. But we are moving towards clocking. Maybe this year we'll do 400 crores oncology sale. That's very, very interesting for us. And in the non-oncology space, majority of revenues come from CMO. The CMO, we always do Q3, Q4, our big quarters for CMO APIs. That's the customer scheduling. We have nothing to do with our ability to manufacture. And if you see the entire API business, it is moving towards 60-40% split between ARV APIs and non-ARV APIs. That's a good thing. And we don't expect our ARV API sale will increase further. Only non-ARV APIs will increase further. So that's the good point to note. When it comes to the formulations, if you look at our Q1, it is 2/3, 1/3 split between ARV formulations and non-ARV formulations. Like diversification happened in APIs, the growth comes from non-ARV APIs. We do anticipate beyond FY24, the growth in formulation also will come from non-ARVs. Because the ARV market is limited and we have leadership position in APIs and we're okay with what market share we have in APIs. But in the formulations, we do expect we can increase a little bit our market share in the ARV API formulations. But a market expansion, product expansion in North America will help us to grow non-ARV formulations. The other point to note, the efforts to diversify our partner base in CDMO is yielding results now. Our CDMO is well diversified. We have a mix of human health, a mix of animal health. these two segments are giving revenue right now, but our AdCam revenues will come FY25. We also have some products with leading global companies in dietary supplements and cosmetic ingredients. The one where we are very happy with our CDMO diversification, we are not worried about if we are only focusing on human health, the risk of failure in phase 2, phase 3 is very high. So especially in animal health and actions chemicals, the chances of products going to commercial scale are much higher than the human health. So well diversified CDMO space. These are the few takeaways. And also one other important point is our bio division is doing good. And the ability for the parent company to utilize enzyme capabilities at bio is bringing in a lot of customers for us. And also some of the customers where we are working, they are also going to see bio or their enzymes. So there are a lot of cross-pollination is happening in the customer base between us and the bio. It's a good thing.
Got it. Dr. Chava, is in the past when we've spoken about what could happen in a quarter over a quarter, you rightly said that the way you're building the business, quarterly fluctuations will happen because you're building it for the long term. I'm inclined to ask you because there are these various parts of your business. You build capacities in various business in order to be able to serve global scale customers. And because of underutilization of capacities at times, as has probably happened in quarter one, your margins take a hit, which were not factored in at all. So my question is the situation currently so fluid that it might become difficult to quite figure out what could happen in 3 months' time in terms of order inflows and executing those orders, even as you have the capacity? And therefore, would it be futile to try and think how soon the recovery could be on a quarter-on-quarter basis, as opposed to try and think about what could happen in the year?
There is, when we made our budgets internally, we did better than our. So it's not that we are unable to predict. We're able to predict reasonably.
Okay.
So it's not fluid. Things are not fluid. That much I can tell you. So the number of projects we are working with customers, the number of CMO opportunities we are negotiating in generic APIs and formulations, number of clinical programs we're doing in human health, number of business development initiatives we're doing in AgChem as well as in. So these are very advanced stages. So if we start worrying about what happened in Q1, we may miss great opportunity in the coming years. So there could be a concern from the market about the numbers what we delivered in Q1, and people are thinking what will happen to FY24. But the kind of opportunities the senior management is working in the organization are very interesting for us.
Okay. I'm presuming that a bunch of these opportunities start taking shape and form materially in terms of delivering numbers in FY25, as is the new contract that you signed in the CDMO space as well, which I believe starts delivering mid FY25 onwards.
You're right, Neeraj. So as we started our dialogue this year being a consolidation year, and we are making our foundation stronger for our growth. So we think that way. So we are not worried about adding capacities. See, why we will add capacities if we don't use them in next 12, 18 months? To get opportunities these days, you can't say to the customer, please give an order, I'll build capacity. Those days are gone.
Sure.
So, people are looking at switching their vendor base very quickly, and we need to able to deploy resources both in R&D as well as in manufacturing assets pretty quickly. and at the scale what they are looking at.
Got it. An argument, Dr. Chava, that comes to the fore in some of the conversations that I've had or some of the notes that I've read is that, yes, there will be a sharp recovery in synthesis or a strong growth in synthesis, which will help you grow with much better operational metrics. And therefore, that consolidation number, while you may have clocked in 14% EBITDA, you'll probably still come back to 21, 22%, which you spoke about in the last quarter by FY24 average. But the argument that is being made is that while synthesis grows, the pivot towards synthesis may not necessarily be so strong that it uproots ARV APIs or APIs as a third of a business, and therefore expect growth. Don't expect scintillating growth in FY25 from Laurus Labs. How would you read into that? Because people are now starting to talk not just about what will happen in Q2, but about the next 2 years.
As the percentage contribution from ARV in general comes down, our margin profile will improve significantly. And our margin profile in CDMO across various verticals are very similar. We are not doing low margin business in CDMO. The second, if you look at our even Q1, did we reduce our manpower cost? No, we have added our manpower cost, employee cost went up. Our OPEX went up. So our CapEx, we did 200 crores CapEx in Q1. So all those had a negative leverage on us. So, but our margins, when you compare Q4 FY23 to Q1 FY24, it's a 50% margin. So, if what is the biggest worry for any organization is if a margins drop, that's the biggest one. So, Q4, previous quarter to last quarter, the Q1 FY24, the margins were stable. So, we are not worried about that front. See, and we have done another 200 crores. Our keep same margins, our EBITDA will go by another 100 crores.
Yeah, sure. But Dr. Chava, people will compare to what used to be in the heydays of 2021 maybe, or even slightly later than that the average margins were used to be 30%. Sure, you at the end of FY23, you spoke about how FY24 consolidation in 21%. In the next 6 quarters, you move up gradually. So that is taken on board. But somebody might also look at a 30% number that came in 2 years back to a Q1 number of 14% and say, hey, what's happening? When do these capacities which are put up by Laurus start showing the utilization which helps them bring back the margins?
I think, see, we are investing because we have conviction.
Sure.
We have visibility. People who have conviction, if they stay with us, they will get benefit.
Most certainly.
See, what happened in FY21 will happen sometime in the future. I will not tell you when, because that is when we invested in formulations in 2015, just 2016, a year of IPO, nobody gave any benefit because of our investments into formulations. Our OPEX, we are expensing about 150 crores of OPEX in our numbers, expensing those. Nobody gave a dime benefit for us. Similarly, we are spending huge CapEx, huge OPEX, recruiting people, expanding our, diversifying our business base. If people don't have conviction, or people don't have confidence on our ability to do, that's up to them. So we have no way to influence their conviction or confidence.
Completely. No, I think it's because of the complex nature of the business that it may be that people don't have the ability to view what you might be viewing. So let me try and rephrase my question, Dr. Chava. I would love to understand, because this might give some idea, right? You've got this multi-year commercial contract with a leading global crop science company. That's a big feather in the cap. I heard you say at the start of this interaction that some of the conversations across various segments with clients are looking very positive. Can you tell us a bit about client conversations as they are currently, and how do you expect them to shape up over the course of the next 12 to 24 months?
When some of our partners visit us, our R&D and manufacturing, we get business. That is the kind of technical capabilities we have built in, the kind of infrastructure we have built in. If they visit us, we get business. That is the kind of confidence we have. And when our partners visit us, they are very appreciative of our proactive way of building capabilities and capacities. So without that now, I don't think we will be able to get traction to get current partners to work with us very closely. And see, if you look at some of our partners are willing to give their phase 3 molecules to us right now. We are also graduating from being a RSM supplier to intermediate supplier, where we are talking now APIs for clinical phases. That's a big positive for us. But if you look at for a molecule go from phase 3 to commercial, it takes 2 years. So we have no way to condense that 2 years to 6 months. So we have to bear with it, travel with our partners program. So I think that kind of shift is happening in the business currently what we are working. So it is very exciting. So we otherwise we don't, if we decide not to invest 1,000 crores in this year, our debt will go down by 1,000 crores.
Yeah, most certainly. Tell us about this multi-year commercial contract with the leading global crop science company, Dr. Chava.
So that is not a very high volume. That's at the same time, it's not a low volume.
Okay.
That project was awarded to us because of our ability to handle complex chemistry, multi-step complex chemistry. So that's the reason we were able to satisfy or exceed the customer expectations in delivering quality at the timelines what we committed. And we are talking on another molecule already with them for development. Actually, development already started. We're talking about the commercial contract for the second molecule. See, our presence in this space is very new. And our presence in this space is seen by these companies. And we are getting opportunities from other players as well. So that's the reason we said this agreement was a milestone in our journey into crop science companies. And we don't want to do tens of thousands of tons per year. That's not our thing here. We wanted to do niche, complex crop science chemicals. Yeah.
Got it. And I reckon, if I remember correctly from a previous conversation, in other molecules as well, there are various which are going from stage 2 to stage 3. And I believe 1 or 2 are moving towards commercialization as well.
One API, we delivered phase 3 and it will go commercial next year.
Okay.
And another few molecules we are talking, actually another molecule will also go commercial next year. So these currently we are doing an advanced intermediate, but our partner is willing to give an API for us. So API validation we are planning to do early next year. But currently we are supplying very advanced intermediate to them.
Okay. Dr. Chava, in terms of what would be happening to input costs and the pressures thereof, there were pressures sometime in FY23. We've spoken about that. Currently, it seems to be more of capacity utilization levels which have led to this thing. I would just love to understand how is the raw material availability, input cost pricing scenario behaving currently. Is there any reason to worry about that for the rest of the year as things stand in front of you right now?
The input costs have softened, and I believe that is the optimum level. If input costs go down significantly from this phase, it is worrisome. Again, one or two manufacturers stop manufacturing, the prices skyrocket again. So it is very good levels right now. So the only issue what we discussed at the beginning of this conversation is utilization of capacity is the key for us to deliver big numbers. We believe the input costs are at very good at this stage.
Okay. In select segments, last couple of questions, Dr. Chava. In select segments, I'm talking about the here and now. In select segments, you had told me last quarter that capacity utilization levels were 50%. You expected them to move to an average of 70 odd percent, maybe in formulations towards the end of the year. Have things changed from the time that we last spoke until now?
No, the things are very similar. So ARV APIs we are running at full capacity. Formulations will go to 70-75% by the end of this financial year, and capacities built for CDMO are very much underutilized. That is the nature of the business. We have to build capacities ahead of our opportunities. So that's the expectation we had. It's not a surprise for us.
Dr. Chava, you've done a couple of calls prior to this conversation, prior to this results interview as well, prior to this results delivery as well. You've had an extended con call and trade yesterday. You spent about 20 minutes with me and a few others with some other media houses as well. Is there something that that all of us haven't asked you about what could be happening in the future, which the street, which the media might be missing, that you think you want to highlight? I would love to know that.
No, nothing nowadays, media especially, and knowledgeable people like you are asking very.
No, sir. But because it's a varied business, I'm just trying to think if there is something that is striking to you as happening sometime which the street is not quite up to speed with.
This is a very interesting and very lengthy question to answer, but I will put sincere efforts to answer this. See, what is happening right now? There is a section of people think we are an API company. Some section of the people still think we are an ARV API company. Some think we are a pharmaceutical company. But something, people who work with us on animal health, they think these are a great animal health company. Some people now think these are a great crop science company. So that's the challenge. But we are doing what we are capable of delivering customer expectations. I think people are missing that point. We are a research-driven manufacturing company. I think once people come to the reality, people will stop looking at ARV, price pressure in ARV. This is very transitional. So we are not an ARV company. Although ARV is important, we are not an ARV company. We are a research-driven manufacturing company. We manufacture ARVs, we manufacture formulations, we manufacture dietary supplements, cosmetic ingredients, we manufacture animal health, NCE programs, we manufacture enzymes, we manufacture recombinant food proteins, we manufacture peptides. So well diversified. All these will take its own time to give benefits. So because of our confidence on these verticals, conviction what we have, we are investing. So people need to have some patience, and if they travel with us, they will see. For us, it's a very easy decision for us to stop investing, retire our debt, and improve our numbers. But we are doing injustice for our future.
On the contrary, sir, sorry if I may, this is the last piece, but you are a promoter, you are doing this company. For you, it might not be that easy to stop because you believe in the future. The only problem that happens in the financial investors world is that they have options. They've chosen to be with Laurus because there is a promise that you and the company bring to the table about deliveries that will happen. And coupled with the fact that deliveries happen is also that the deliveries happen in a particular time, right? And which is where I believe some of the notes that have come out today are talking about that are the timelines uncertain? I think that's the only thing that probably is something that the street seems to be not quite able to get a handle on.
Well, see, as we mentioned multiple times, this year is a consolidation. And people expect us to grow significantly this year. It's not good. But the future looks very bright. That's what we can say.
Sure, I understand. Dr. Chava, and that is what I wanted to get from this interview. We wish you all the best for the quarters ahead. And in some sense, if I can use that term, recovery in capacity utilization levels during the course of the year. Thank you so much and congratulations on a unique contract and wish you all the best for many more.
Thank you, Neeraj. Thank you very much.
Thank you for talking to us today, sir. And viewers, thanks for tuning in.